Good morning, everybody. Welcome to the Flow Show. A new week begins, and we look forward to trying to make some money out of it once more. Hope you've all had a good weekend. Kay, you had a good weekend?
Good morning, Ryan. Good morning, everybody. Yeah, I had a decent weekend. Yeah. Oh, you're saying you want to make money out of this week? I thought you were just doing it for leisure and pleasure, you know.
Feels like it sometimes. I don't know where the pleasure part is at the.
Yeah.
at
Oh,
moments.
yeah. That's a fact. Let me just check my volume, but because I don't know whether it's you are a little faint, perhaps, a little far away from the microphone, or my volume. It may be you. I don't know, our listeners, if you hear Ryan perfectly or also a little soft.
Yeah, I'm a little bit away.
Hey, Mark. All good. All righty.
Yeah.
Okay, let's go. Shoot.
Cool. Right. Yeah, you might need to unblock your ears, mate. Or sort your speakers out. Anyway, let's not have any technological difficulties right at the start. You sound fine to me. Yeah, same as what Scott says. You sound fine to me, mate.
Okay.
Right. Well, let's have a look at a few bits and bobs going on. China over the weekend had some CPI and PPI data out. China posting another gain in CPI, 0.3%. Not really inspiring, though, beating the 0.1% expected by 2 pips. But that's now 2 months of positive inflation, although PPI is still heavily in the negative year on year, down 2.5%. So they're not out the woods yet there on inflation. We do have a bit of Chinese data out later on as well, which we'll talk about shortly. What they're also doing, apparently starting May the 17th, is starting up a debt sale of over 1 trillion yuan. This is to boost the economy. Now, this is potentially a bit of a big deal because they're not like other countries that are always issuing debt every week, every month, every whatever. They only do this sort of thing, really big clumps of it now and again. Their last big sale like this was in 2020. Then you've got to go back sometime before then, 2007, I think, the one before that. This bond sale is very targeted, so it's for specific measures that they want investment for. So that's the nature of the sale as well. So it's going to be people buying bonds for specific projects, and like rather than just a broad money raising escapade. So anyway, that starts May the 17th. Market may look at that to see what the take up's like, particularly outside of China, foreign take up of that as well. So one to keep an eye on later. Over to the Bank of Japan, and the BOJ have announced they're they were buying smaller amounts of bonds today versus their last operation. They've reduced the amount of JGB purchases in the 5 to 10 years to 425 billion from 475 billion. That's perhaps not big news, although some people might start jumping all over that as them starting to reduce bond purchases. They can change the amounts as and when they see fit, mainly to do with liquidity and stuff like that. If they don't see a need to buy as many, they won't necessarily buy as many. But don't think, Kay, we should draw any big conclusions that this is the start of the big JGB purchase reduction or anything like that.
No, and they've already said that they were looking for ways to reduce the JGB buying, right? Now, the thing where we need to and we need to wait over time to see what their total amount is, if they're going to get well below that what is it, 7 trillion yen annually maturing in Japan. So I mean, because if they go well below that amount with their own buying, that means that net there will be some leftovers there and could potentially push the yields a little bit higher. But so yields have pushed up a little. Take those 10s as an example. I think we're like 2 or so, 2.5 BPs higher than on Friday. We still have to, because that's going to be a big psychological level, right? See what happens around 1%, because they do keep that button behind the door where they can go with unscheduled buying if they find that the market is going too fast. We will see, and hopefully we will get there to see what they do around 1%, because that would be the real message. If they don't come up with unscheduled buying as soon as we hit 1% on the JGB 10s, then that is going to be actually a bigger message than reducing the JGB by buying by 50 billion yen, which is $500 million, which is not really, or less even, which is not really a huge deal. But it's all part of the plan, right? That visit from Bayueda to the Prime Minister's office, government cooperation, all of it is all still part of that plan, and still part of the slow plan, because they want to really prepare the government, and the government hopefully has already done a few things themselves, their end. So yeah, to me, it's like, what's going to happen if we hit 1%? And then what's going to happen if we start to hit, you showed the 20s there at 1.75%. What's going to happen there if we start to hit closer to the 2% mark there, which is a way to go. But as you can see, we've done about 50 or so, give and take, or 50, 60 BP since the start of the year. 50, I think it is. And so another 25 is very possible. And then we will have to see what the reaction of the Japanese investors is. So it's all part of that big mechanical machine that is going to bring those yields higher in a very slow manner. And then in the hope that the Japanese investors react, and in the meantime, they hope that the rest of the world is falling apart to stop the Japanese yen's growth. Because as we have seen, the Japanese market has not been, the yen market, the currency market, has not been impressed by this reduction of 50 billion yen, right?
No, exactly. But yeah, it's as you say, it's going to be another one of these things that we have to look over the longer term to see how the market's going to take it. So yeah, but anyway, not for anyone to get too tied up in these daily buying amounts is the main story, I think. Over at the Bank of England, we had the chief economist peel out again, saying that we must focus on persistent components of inflation, not headline rate. But then he said the persistent parts of inflation are falling. He said the MPC has sent a relatively clear signal that the bank rate can be cut when there is sufficient evidence of a downward path in these persistent components of inflation. They added that focusing just on the next BOE meeting is a little ill-conceived, i.e. don't put all your eggs in one basket regarding the June meeting. ECB's Elderson says there is no commitment on rates beyond June, and the June cut is most likely if the outlook is confirmed. We also got the ECB minutes out, not a huge amount in there. Members expressed increasing confidence in the staff projections. That'll be a first. They said it was widely shared that further evidence was required to gain sufficient confidence that inflation was solidly on track to return to the ECB's target. Fed's Bostic says he feels US central bank is on track for a single interest rate cut this year, though the timing is uncertain. He's thinking less about the extent of rate cuts this year and more on getting the timing right for the start of easing. So the gain of 175,000 jobs in April may be the low for the pandemic era, but still above what the economy needs to account for population and labour force growth. So he's not being dismissive about the NFP data that we got. Fed's Bowman is being a hawkish self, saying having continued momentum in the US economy, so we need to keep policy steady for a bit longer. And then came out a bit later on saying doesn't see rate cuts as warranted this year. That's keeping the hawkish stance there. Some of the other wafflers, Fed's Logan says there's substantial progress made on inflation, and the labour market and economy is strong. It's too early to think about cutting rates, but we need to remain flexible on policy. Says there are uncertainties if policy is sufficiently restrictive. There are important upsides, risks to inflation. Then we have Fed's Goolsbee, who's he's becoming a bit of a mess, if you ask me. So he said, currently, there's not much evidence that inflation is stalling out at 3%. Then said he's hesitant to focus too much on recent inflation data, saying we've made a lot of progress. It was only a couple of weeks ago that he said inflation over the last 3 months cannot be dismissed. So 3 months ago or last month, he said the inflation can't be dismissed, and now he's saying don't focus too much on it. So I really have no idea what this clown's going on about, but he's not making much sense as far as anything to do with policy goes. Cash and Carry was out saying the bar is high for another rate hike, but we can't rule it out. He's in wait and see mode about the future of monetary policy, and he's cautious about how restrictive monetary policy is. Kay, the usual flood of Fed speakers, most of them clear as mud. What do you take from these lot?
I think the market reaction, let's say, the market reaction to what they are saying, which is ignoring it, is right, because that's what data dependence tell us. So without needing to confirm that most of them are donuts, the market reaction is one of data dependency, and so will they be, because if we get a slew of very low inflation, or lower, not very low, but lower inflation data this week, they probably will have to change their approach again, right? So that's I'm just leaving them for what they are, and yeah. The bad thing would be that inflation is really very sticky this week, because that's quite a few of them will be right. So
yeah.
But yeah, no, I'm not making too much of what they are saying right now. Goolsbee is a real weather vane. He doesn't know whether it's what he thinks really. Kashkari and Bowman really are the hawks, and well, they are fulfilling their hawks role when they speak. So that's about it, mate. I'm not going to spend too much time on them.
Yeah, exactly. I think they're pretty indicative, as you say, of how we're all thinking right now. You know, no one knows what's going to happen with policy. We all know that central banks are looking to cut. We know some are touting when they're going to cut. Some have started. Others don't know. RBA, you know, Bank of England shifting a bit more dovish, but they still don't know. The Fed doesn't know. The ECB think they do know, but they don't know after June. They don't know longer than the end of their nose.
But it does bring us back to, apart from the Uber doves or the perma doves, it does bring us back to what you've been saying for a long time, even since last year already, and that is that they don't want to make the mistake on the other side of the mistake of what they made at the start. So, and I think that's why some of them like really keep this rhetoric. I mean, just saying that the bar for hikes are high, I really think it's going to need an extremely big accident for them to hike, because none of the central banks would really, they would hate to have to hike, apart from Bank of Japan, of course, but that's a completely different story. But all the others would hate to have to hike again, but they don't want to make the mistake to cut too early.
Yeah, exactly. Very much so. I mean, it's been a surprise that they have shut the door or pushed the door as closed on hikes, rather than keeping it open. But that's where their bias has sort of fed into it, because there's not that many central banks that want to be hawkish. They'll, you know, take the ECB. They're always far more dovish than they are hawkish. But yeah, they can make their bed and they'll lie in it, and we'll just trade it whichever way it goes. It doesn't matter to us which way it goes. We'll just trade it anyway. Right, let's have a quick look back at some of Friday's data. There wasn't a lot out. We had Canadian jobs, which came out a bit of a boomer, caught everyone on the hop a little bit with a big 90K print there of the employment change. Was only expected to come in just shy of 21,000, so that blew the doors off. Decent numbers in the full-time, part-time, although the part-time was a little bit bigger, but that's still a decent gain, 40K in full-time employment. Both going up suggests plenty of activity. Though I would say this jobs data can be a bit volatile. We can just as easily get a 50K drop next month as we could see another gain. Probably more importantly, the unemployment rate came down, or rather came down less than expected, was expected to rise, came in unchanged. But that wasn't too bad as the participation rate went up a pip. And on the other side, wages, that came down 2 pips to 4.8%. So that's something going the right way for the BOC. So this is puts it well in the soft landing territory. Then we moved on to the Michigan data, which was a bit of a stinker all round. This is starting to get a bit volatile as well in this number. So we had the headline number was expected to only drop 1.2 points. It actually dropped a whole ton to 67.4. Current conditions pulling back, over a whole big figure down. That wasn't good. Expectations coming down as well. But then we look at the inflation numbers. Got a big jump in 1 year inflation, 3.5%, and another jump in 5 year, 3.1%. So not good numbers for the Fed. Really keeps them between that rock and a hard place. Potentially the consumer is seeing, let's say, less rosy days now and ahead, but they're also seeing higher inflation coming as well. That's not a good cocktail for the Fed in any way, shape or form, because what do they change rates on? Do they cut on a weakening consumer or potentially weakening consumer, or keep them steady and even hike on higher inflation numbers? So not good numbers, Kay, for the Fed. What do they do with that one?
Right. The thing is, we see this, especially the Michigan. I don't recall exactly the ISM number, but or the confidence, the prior confidence numbers. But we see this system of communicating vases, right? If when inflation goes up, just consumer is not happy, and what do we do with this? Well, let's say I don't like these numbers because we need the consumer to continue to support the economy, right? So I'd say that on balance, this is not a great number. Yes, it keeps those inflation expectations very sticky and even ticking up. But I think all in all, what's going to be the most important is probably the consumer in the end. But then I found the market reaction quite typical. Tried both sides of the numbers, and in the end couldn't make up its mind. This is the market that we trade in, and remember what's or for our audience at least, remember what I've been saying. This is Q1 was a pretty clear picture where the dollar was going to take back what it lost over the second part of 2023, and Q2 is going to be your messy quarter, and then hopefully in Q3 we will see clearer again. We are in the midst of this, and if you look at market reactions, if you even look at the market reaction after the Canadian job report, that's exactly where we are. We are in this messy environment now where we are data dependent, but the data don't show us something clear. Okay. If you would have had for instance, inflation coming off, but then the consumer not liking anything at all because jobs, for instance, are starting to slow down and everything. That would be a clear picture. But now we are not getting those clear pictures. Okay, market trying to hang on to a weekly jobless claims that nearly didn't move for weeks on. I mean, this is where this market is. We are in this messy environment right now, and hopefully once June comes, we will have more numbers, we will have more data, and then the picture may start to get clearer. You know, I mean, for now, I think we are still barring some currencies or some patterns. We are in a very unclear situation, and that's very much reflected in what the market is doing right now.
Yeah, exactly. And you know, I think the ECB is going to be one of the key points to look at. You know, if they do cut in June, but they don't signal a quick cut in July or the prospect of quick cuts, you know, don't expect the euro to get dumped on the ECB cutting rates. You know, the market's already traded the cut coming. You know, so don't think, oh, we're 2 days for the ECB, I need to load up on euro shorts, because it could actually go higher. So you have to know, again, the risk for something like the ECB is that they don't cut in June. That's the big price risk, not that they do.
Wow.
You have to,
if they don't
take
cut,
these
then
moments.
If they don't cut, then I think I'm going to be in a little bit of a rush to buy euros if they do not cut in June, because that would be the mega surprise now.
Yeah, exactly.
But you're right in saying even if they cut in June, don't expect too much. But we could be in a how should I say, a bit of a sell the rumor, sell the fact, but then buy the third wave, you know.
Yeah.
Because we know now, I mean, everybody know, well, I mean, we should. This should be the thing that ECB is nearly a done thing. So the whole market knows that right now. So, I mean, why would you trade more than what the market is trading things? That's one of my approaches that I have. And that's also linked to fundamental trading and everything. It's like, trade what the market trades. If you're the only one trading something, it's likely going to be at least, well, at best random, because you're the only one looking at it. Just trade what others are trading as well, because, and if the market does not trade your differential between the euro and the dollar, it may mean that those big heads are, or the big position drivers, the big market drivers are not trading it either. So I think, yeah, it's a very fair point saying that even if the ECB cuts, and I think they will, if the market doesn't trade it, why would we, you know?
Yeah, exactly. But again, you know, it just shows the nature of the market we're in. You know, I'm saying, yeah, it's you know, it's a done thing that they cut in June, and the market may think they may not cut after. We've got 2 CPI reports. They're currently on 2.4%. If 2 CPI reports and they're down at, you know, 1.8, 1.6%, something like that, then yeah, you can guarantee a July hike's probably nailed on, because they'll be worried inflation's falling too quickly now, and we're back on the other side of the coin. So yeah, we're all data dependent. You can't, and take this from someone who likes trading long term. I like trying to pick up the trends, pick up the turns in the data, but you know, things like this right now, it's seems like every day, every data point is a coin flip, and you've got to trade it as such until you see a decent trend emerge in one way or another. Right. Over in the US, Biden is to double or triple and maybe quadruple some China tariffs on key products, although solar manufacturing is going to get an exclusion. And the White House apparently going to avoid rolling back any other Chinese tariffs. This is part of the next stepping up from the Biden administration hitting China on various bits and bobs. But they are going to be meeting in Geneva on the 14th to discuss the risks of artificial intelligence. And of course, the US are going to raise concerns over China's AI development in those talks. But anyway, it's another set of meeting that the Chinese and US officials are going to have, which may prompt some headlines from that. Right, quick look at what's coming up this week. Nothing today, so we can probably all go and have a little snooze. Come back tomorrow. We get some inflationary data from Japan, PPI numbers, and then we're going to get some of the final readings of CPI from the Eurozone. Got the UK jobs market tomorrow morning as well. That's still a bit of a mess because the ONS are still trying to work out how to use their calculators over there. Really, for this one, keep an eye on the wages number. That's unless there's some sort of big variation in the other numbers. Just keep an eye on those wages numbers. If they're softer, that's going to probably ramp up expectations for the June cut for the BOE. Then we get to the zoo, Germany zoo. So we'll see whether things have improved over there at all. Now, a bit of a strange one this week because we get PPI before CPI in the US. Usually it's the other way around. So this may add or take away from that CPI data on Wednesday. But it, to quote Kate, could also produce some saloon doors. If we get a big jump up in PPI, that's going to put some expectations on the CPI and vice versa. If it's a big negative, then people might be expecting CPI not to be as hot or to be a bit lower. So a bit of a messy one this might be between the PPI and CPI. Also, retail sales as well coming out at the same time. So that gives us, again, that view on the consumer. So, again, it could be a bit like the Michigan. What if CPI goes up, but retail sales show a weakening consumer? It puts us in the same boat. What does the Fed do? Act on the weakening consumer or act on high inflation? Or they could both be good or they could both be bad or vice versa. So lots of permutations for this, going to make it a little bit messy. Empire State kicks off the manufacturing data for May over in the US. That one's been a big flip-flopper of late, so wouldn't hang your hat too much on that one. I would also say keep an eye on some of the inventory numbers that we get from the US, again, just to see about signs of activity. If firms are drawing down on inventories, that may mean that then don't see decent sales or orders ahead. So they'd rather go through stock than order new stock and keep high inventory levels. So that one needs to keep monitored. We also get a bit of housing data coming out as well. I know we've got starts and permits coming out this week too, and some of the other numbers also. Those starts and permits happening on Thursday. Then we get, must be the biggest number since last week, Kay, the jobless claims. I wonder if we'll have a little flip out on that one again.
Yeah. I mean, imagine that we go down to 229 or move up to 231 from 230. I think the market is going to go all ballistic. Now, I mean, I think on Wednesday could be a bit of a tricky one. Yeah, and again, it's going to be interesting because the PPI comes out before on the US. But CPI still being such a big thing, I would suspect that it has the upper hand above retail sales and the Empire Manufacturing Index. But I wouldn't dismiss those retail sales because there's a small, let me just quickly look. Are they expected to do a little better this week? Wednesday. Just quickly checking what they're expecting there.
This one has them doing well,
right?
0.4% on the month.
That's
positive numbers.
Because imagine that we see a bit of a slightly weaker CPI and then a miss on the retail sales. We know this market loves to sell dollars, right? And that could be a bit of a hammer blow to the dollar. One of the good forecasters, or the better forecasters, if they exist, but they seem to still exist, one of the better forecasters is thinking that the retail sales are going to be okay. So then that would put the emphasis back onto the CPI. It's going to move whatever happens, because this market will rebalance any expectations, or the bond market will move whatever happens, right? So we should see a bit of moves this week in the dollar, right, on the back of the CPI. Now, if we get, because we saw, and there are by no means red flags, because I mean, one of the commentators was right in saying that after on 175K job creation is above what the economy needs to expand. So and I haven't seen the latest numbers, but what I remember somebody saying was for as long as we're above 80 to 100K, all in all, we are doing all right since the pandemic. It used to be higher, this number, the required number. But if we see like those little yellow orangey flags pop up, and if you have like quite a bit of a lower CPI, but then people are going to try to combine it with those job reports that we had last week, and I would still expect the dollar to be quite on the defensive if that would be the case. If we see a stickier CPI, then I'm afraid that yeah, we may see some of those dollars test higher again, and I mean, at least two guys in the room, Suzuki and Kanda, won't like a higher CPI in the US. That's for sure.
Yeah, exactly. Then, yes, let's not forget about the intervention threat, because apparently they love trading data points too. I'll say that with tongue in cheek. Yeah, so that's Thursday. Philly Fed as well. Industrial production on those days as well. Bit of inflation. Oh, jobs in Australia. I nearly forgot that. And GDP in Japan on Thursday too. So they're going to be looked at, obviously, for their connotations for their respective central banks. Friday, we get a bit of Chinese data as well. Industrial production, retail sales. That could be a bit of icing on the cake for whether they're going to ease rates again. Q2 has been suggested that they could do that, and we're smack in the middle of that at the moment. That Eurozone inflation number is the final number, so it shouldn't be too much of a variation, but we'll watch out in case it is. But just to add another spanner in the works for trading between Tuesday and Wednesday, we have Powell speaking at 1400 GMT in a moderated event with Klaus Knot of the Netherlands at the Foreign Bankers Association AGM. So it's a moderated discussion there, which may be a bit of an opportunity for Powell to he's had a look at what the market's done since the FOMC. If he feels that he needs to steer us in any direction or another, that will be his opportunity. So we'll get that data, then we'll get Powell, and then we'll run into the CPI. So it could be a bit of a hairy time if he does decide to give us some comments additionally to what we've got at the FOMC. Right, so that's all that's going to be a busy week. Oh, they all seem to be busy weeks, well, apart from last week. But they all seem to be busy weeks at the moment. We're all hopping from data point to data point, but that should give us some volatility. Right, let's see what's going on in markets. Angela just asking about Euro Sterling. Yes, I'm still in my long, Angela. Oh, let's come in a bit closer. There she go. Let's go to an hour. Yeah, I'm still in my longs. I did get some out up here into my zone when we were up here at that point, because I thought it probably best just to take a little bit off in case we don't break through there. We didn't. You've got 86.30.50, which is thereabouts where I'm looking. So yeah, I cut a bit of my recent longs in there. Still got the core. Didn't add back. I was looking for a dip closer to 85 in this move to get some on, but didn't. So I'm not doing a lot up here. I'm going to be offloading in the rallies and picking up on the dips if I get them. Still, there's no reason I see why we need to go anywhere fast, but we've got the data coming up. So if we see the soft data for the UK, then this is probably going to make a decent move above 86 at least. We're holding. We can't seem to really make a decision whether we're going to climb above 86 and hold it. We've got these little minor points, 86.10, 86.20, that have been on off levels, but we're holding above this 85, 70, 80 area. So that's really your pivot area. If we're back below there, then we're back into coming down towards these low 85s. But if we can get above 86.20, then we're probably going to test this zone, and then we'll see what happens there. But yeah, you can never take this one to heart too much. As I say, we've been here before, and then we've gone back below, and we've been up here before and gone higher and come all the way back down again. So if you're trading this one, it's good. It's a good range trader at the very least, buying those low 85s and offload them when you can on the way up. Cable, I'm also still in this one. On the other side, I'm long the pound on this one, and it's holding up. Obviously, we had that decent move up there in March. Then we came all the way back down. Then we've bounced. This 124.50 that held up over the Bank of England. That was a bit of my trigger to get in a bit along there, which I'm still in. We're just ponging now between up this 125, 45, 50 and the 125 big figure. So really take your cues from which way this one goes. If we get back below 125, then we're probably going to be going back to 124.50 or worse. On the other side, get back above here, and we'll probably take a look at 126 and see what it wants to do there. But this bounce is still holding pretty well. It stopped where it wanted to stop, where it needed to stop. So let's see if it's going to continue, or if we can't break out from these lower highs that we've seen on that one. Let's see what else we're going to look at. Gold, it's still being very sticky, but I think we're getting to a point where something's going to have to happen. Oh, by the way, Kay, I don't know if you read, Nvidia is now the new inflation hedge, not gold anymore. If you can, believe that headline.
And what about Bitcoin? I mean, I thought Bitcoin was the
news, mate.
hedge. I mean, what's happening to this market? Come on.
I know, it's like I said in the chat room, I saw that headline, Nvidia's a new inflation hedge. I thought, if that's how we're starting the week, I'm going back to bed. But absolutely bonkers. But yeah, I mean, how you can still call gold an inflation hedge when inflation's done, it's come down over the last 12, 18 months, and gold's gone up this year. So yeah, good luck working that one out. But we had a little pokey up above this 2360s area. It hasn't held that. So we're looking like we're ranging. If it had held that, then maybe we were going to have a look at that 2400 level, which is still the main resistance level. So this one just keeps it in the box a little bit. Got all these sort of minor levels popping up and down. I know Kay's got this 2220. That's your main level down there, isn't it? 2220s. One of yours.
Yeah. I need to go. I was looking at something else. Sorry, Ryan. Yeah. Yeah. Well, 2280s, 22.75, 2280s, and then 2220s below there. But where it held, the dip or the drop, let's say early May, that's a very, very nice level there around the 22.75 as well. And I was just looking at the S&P, and this is very strange because we have an exactly the similar kind of trend line that held in both. When S&P corrected a bit earlier, and we are looking at a pretty much similar pattern. That's quite strange because I was just looking at both right now. I'll show the S&P as well. There's very, very good levels there. Yeah,
cool, mate. Just a quick look at the old bond scene to see what's going on here. 2 years, and it's had a bit of a bounce back following the FOMC. Again, this is another one to keep your eye on over the US data, and particularly Powell. and the rest of it this week, because it will start to indicate whether the market's happy with the FOMC and not putting not putting hikes on the table in any explicit form, and whether the market believes that message, depending on what we get from the data. You know, if we get good retail sales, if we get hot or sticky inflation, PPI, then we're probably going to start creeping back up towards this, the one cut area, let's call it that, with the market getting a bit more hawkish again as the pendulum swings once more. So this is a bit of a follow, and the dollar's probably going to follow this as well. So if you want your proper correlation as to what the dollar's going to do and how much it might move, keep an eye on 2-year yields over the data as well. If the dollar shoots higher but yields haven't gone as well, then you might find that that sort of move reverses a bit as it catches up, back up with yields. And also 10 years as well. Again, that dip since the FOMC, and now we're just mooching around this 4.5% mark. Again, take your clues whether we shoot above or come down below. That'll be your gauge for the market's rate expectations. Kay, you got anything you want to show us?
Yeah, quickly, to start the week. And I'm first going to show this S&P I was watching. I mean, okay, the levels are far away to the downside, but there's a couple of interesting ones going into this inflation week and with the Powell. And I just wanted to show this red line here, and I did show it at the time that when we were there. So if you're looking for something that the market seems to have traded, look at for the more medium term at this red line here. Put it on your charts, I'd say, and look what the market does if we get a retest. But in the meantime, zooming in a little bit, going into this inflation week, we've seen this stock market really, in general, stock markets are very big, and we are slowly coming back to the levels where we were before, right? Those highs. So 52.40 is one that I'm keeping a small eye on in this in the S&P to start the week. Then you have closer to 5,200. And then we have the prior lows here in the 5160s that we should perhaps keep an eye on. And but I think really the 5100 is going to be where, if we get some big stickiness on inflation, and we would see a 2.5% drop during the course of the week. Keep a close eye on what's happening, and by the time those ones could actually be together here, just around 5100. I think that's going to be an interesting level enough to watch over the course of the week. And then of course watch the top side, yeah, because if we see the inflation come down and the market takes this both mildly weaker job environment, the other side of the dual mandate in the FOMC sees this with a combination of this slightly lower CPI, then I think we are going to for a retest and perhaps even blow off above the prior highs. And then I've got extensions here, 53.70, 53.80. That I think is a decent zone to look at, and I'm probably going to have, hopefully I've got them, yeah. So I've got them on the dailies as well. This is your gateway to 5,500, I'd say, if 53.70.80, okay? And then above there, 54.40, and then above there it's 5,500, all right? So if we would get a drop in the CPI, the inflation data, so the combination of the PPI, the combination of the PPI and the CPI, okay? If we get a slow one, I wouldn't even rule out such kind of moves over the rest of the week. And unfortunately to say, again, all retail, not all, but the overall position in the retail market is, of course, to counter trade moves, whatever happens. And now the retail market is short. So watch out if this 52.80 goes again, all right? So watch out, be warned if 52.80 goes. Then this chatter about MEX. Yeah, we are, and I don't know where you saw your support really, Ryan, because you were showing some kind of support in the room, and I'm
Yeah,
so
60, 65, 70.
oh yeah, here, this one, the 38.2, yeah.
Yeah,
Yeah,
around about, yeah, in the middle, yeah.
okay, alrighty. Yeah, this is a support. Then also a little bit of trend line support coming out or coming in around 1660 now. Um, Mexico didn't give us much, but they did hold the rates still. So that means that we're still looking at an 11% currency, right? So I still think it is a bit of a danger one to catch knives. But of course, I'm half talking my book. But we are below this zone, 1678.82, right? We are just not far from. We are just below, running just below. Um, Double-edged short here on the US data, you know, because a much higher, we need a much higher US data print to put pressure on risk to turn the mix around and to put a bit under the US dollar. It's going to take a quite high inflation report. On the other side, we all know the proximity of Mexico and the US. So a sticky one is perhaps quite a difficult read. If we get a bit of a small slowdown, further slowdown of CPI, I do think we could test those 1660s, you know. And then I would again issued a warning that if ever we get below 16.5, even Lopez Obrador, our good friend, the Labrador, the Mexican president, did actually say himself that he thought that the Mexican peso was too strong when he traded under 1650. So if we ever would get there, pay attention. This different one again, and I know the euro is holding up quite well actually against most everything, because now Euro Swiss is ticking up, Euro Canada ticking up. But this one, I'm still a bit short from the Banxico. We are on a bit of support here, all right? 1803, 1801, 1797. But yeah, the 1800 will be a bit, the 18 big figure will be a bit psychological again. So if it breaks, I think we can go back to 1770s and then see where we are in the dollar mix, you know, to look at the viability. But I still like this overall downtrend, and I especially like the fact that I'm getting paid to be in a position. So this is still what I like. I'd be long Mexican, of course, being the obvious one, but I'm just a bit too worried about any time possible inflation in interventions right now still. I don't think speed warrants it, but perhaps the levels do warrant something from the interventionists in Japan. I'm really not sure. Otherwise, of course, the Mexican is a good one. Since last week, it already 2.5% higher again. This one, but I like this one still, and I still think it looks heavy for a retest of the lower ones there. So don't change a winning team right now. Quick look at what's happening on the Swiss franc. It's been really, 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 really quiet for a while. But Euro Swiss is now trying again. We're just above this 97.75. This would be nice if this starts to hold for a move back higher. The looks perhaps a little flaggy here, needs to break above 97.90 to start going again. But this is a bit the other side. Swiss is a low yielder now for as long as there's no panic on geopolitics or there's anything stupid happening in the rest that would send euro down due to economic data or so. This is still a relatively okay position, and I'm also running the sterling Swiss, but this one is testing patience, really, really, really testing our patience. It's hanging around this 113.5. Yes, we are holding the global trend still, but it's very, very flatlining. So it would be nice if we start here to take this 113.75 again and run higher. But in the meantime, again, we're getting paid for to hold the position, so I'm still holding on to it for as long as we hold these high 112s. Right, here we are. Dollar Swiss brand is pretty much similar, but then the dollar has been trading a little bit soggy, right, of late. So we're getting a bit the same picture here, but it should really, but I mean, in the very short term, 90.85, 95, that should give way again to start to move higher. You see this little resistance here. We've been turning around several times in the past. This looks to be a bit of a resistance area. On the downside, low 90s. For as long as those low 90s hold, probably no change, and you're also getting paid if you are in a long position, not a Swiss, but it should really break above 90. Sorry, 91, 40, 50 to start really going again. For the time being, this looks extremely rangy. Any other comments? Any other thing that you guys want to look at? Super independent swings, right? Where bad news, lower retail sales, higher employment, falling marks. Yes, absolutely, Kavi. That's what I've been saying as well. When bad is bad, things will start to turn around. But we are not there yet, I think, in the terms of red flags. You know, the flags are there. We have seen a bit of lower wages. We have seen a bit of sorry, a bit of those lower numbers. But it's not yet there to really ready to fall out of bed. And for as long as the numbers are not really crapping the bed, money still has to go to work, and that's what's holding up your equity markets really right now. And with that, Ryan, back over to you. I'm going to be off for the next 2 days. I've got family, friends coming over to visit us, so I'll see you guys back on the Flow Show on Thursday.
Thank you very much, mate. Have a good couple of days off. Enjoy it.
Thank you.
You'll have one eye on the markets anyway, so it won't get rid of you that easily. But yeah, that's got us set up for the week. Have a great week, everybody. Thanks for coming to the Flow Show. Cheers, Kay. We'll see you all tomorrow.